Good afternoon, and thank you for joining us today on this Money Smart Monday. I'm Pennsylvania Auditor General Tim DeFore. Today, we'll be talking about managing accounts and saving in regards to youth and young adults. We are joined today by the Pennsylvania State Employees Credit Union, who will be providing some great information for our younger Pennsylvanians. I'd like to introduce Chris Ryan from the Pennsylvania State Employees Credit Union, or PSECU. Chris, welcome and thank you for joining us today.
Thank you, General DeFore, and thank you for giving PSECU the opportunity to talk about the importance of getting youngsters down the right path regarding financial matters. Although we always want to help young people build and develop solid money management skills, we're putting the spotlight on those efforts during April, which is National Credit Union Youth Month.
All right, and that's good information. So thank you. So before we get started with our first question, I want to highlight that we are in the middle of Financial Literacy Month as well, which occurs every year in April. And it's important that we take time to help Pennsylvanians learn how to be money smart, and so we can help improve the Commonwealth. And it's never too late. It's never too early to start learning about how our money works. And that's why I'm so excited to hear from some of the industry professionals, such as the Pennsylvania State Employees Credit Union. So let's talk about some basic money skills first. And how can some younger Pennsylvanians, and quite frankly, some young adults, start learning good money habits?
Really good question. When thinking about what we can do with our money, most people lean towards two things: saving or spending. But as a credit union, we embrace our industry's philosophy of people helping people. And as a result, we include sharing as a third option and encourage parents to try some things at home. So I want to talk to you about the three jar system. A lot of times in budgeting, some professionals like to talk about an envelope system. You know what I mean? I have my save envelope, my spend envelope, things like that. So this would be we call it the three jar system to use with some of your youngsters. I've used it with my 11-year-old daughter. I am a parent, so I can tell you it can be a lot of fun and rewarding for both you and your youngster. But so to do this and help your young person learn some money management, the three jars are: you have a save jar, a spend jar, and a share jar. And you let the child decide which jar or jars to put their money in, depending on their goals. And I would say, another way is opening a youth account. Is another way for them to learn really good money management skills. I mean, get them into that process. I always like to call it, to exercise that financial muscle, or earlier than later. And PSECU has several options for a youth account, depending on the child's age and type of parental controls you'd like. That's another beautiful thing about a youth account, is the parental controls, obviously. I would say details about those accounts can be found on our website at psecu.com/youth. That's psecu.com/youth. Our website has great tips and information about youth and money, including some short videos. And I would really recommend going out and taking in some of those short videos. You can actually watch some of them with your youngster. And those can be found at psecu.com/blog. That's psecu.com/blog. And they're not, and actually those little videos and articles and things are not just relegated to just youth. There's various different topics out there.
And that's I really like the jar system. That's that if you want to teach kids very early on about saving and spending, I always felt that's a really good system, to use. So thank you for sharing that. So you mentioned about setting up accounts for children. So let's talk about the difference between if you want to for a credit card or for a co-signing. What's the difference between being a co-signer and an authorized user?
I'm really glad this question came up. This is one of the most asked questions I get on when I spend time on college campuses. Speaking with parents, specifically parents and students, regards to helping students build credit. So let's unpack this a little bit. So we're talking about the difference between an authorized user and a co-signer. All right. The main difference lies in who is responsible for any debt, right? So that's the key thing. So authorized user, right? So let's talk about authorized user. An authorized user is someone who has permission to use an account. Oftentimes you'll see this with credit cards. You maybe have a parent or guardian give their student, they want them to have access to a credit card, if they're traveling or away at college or camp or something, and they make them an authorized user. So that basically just gives them permission to use that account. The other term we brought up are co-signers, right? So co-signers are actually legally responsible for any debt, while an authorized user is not. So, when you co-sign, the co-signer is also legally obligated for that, legally responsible for that debt.
So, yeah, so in staying in that same realm, what are some of the pros and, of course, some of the cons of co-signing for a credit card for a youth, if you're even a grandparent?
Yes, good. Let's talk about this, because this is one of those, we talk about personal finance, and a lot of people are hesitant to tackle this topic. You know what I mean? This is one of those things, just unpacking and understanding what some of these terms mean. So co-signing is a type of joint credit, and I'm going to repeat myself here a little bit, but co-signing is a type of joint credit that allows a borrower to get approved for a loan or get better terms than they otherwise would not. Okay, so in a real life situation, if I was a freshman in college and I needed a car loan, but didn't have a long credit history or a full-time job or something, but I needed a car, maybe I could get a guardian to co-sign for me. So then I would qualify, for that auto loan in that case. So in that case, the primary borrower receives the loan and is responsible for the payments. However, if the primary borrower cannot or does not make their payments, the co-signer is also legally obligated to do so, right? So again, that's where a co-signer, I was going to say, is really on the hook for that, for that payment responsibility as well. So let's talk about some of the pros of that. Some of the advantages to that, again, the individual you're co-signing for has access to credit they would not otherwise have. And as long as the borrower repays on time, you both should should not experience any negatives. Paying on time can positively impact both the primary borrower and the co-signer's credit scores. Now, what are the cons, right? So the cons are, if you're co-signing, you'll be responsible for repaying the debt should the individual you're co-signing for fail to do so. Well, you're like, well, what happens then? Well, that additional debt could negatively impact your budget, put your assets at risk. And if you have difficulty making the payments, the co-signer's credit report could suffer as a result. They could have negative impact on their credit score as well as part of the co-signer.
And one of the things that I've constantly been hearing about as we've been doing this, we're constantly talking about credit, and I can't emphasize the importance of having a good credit score, because that's going to impact when to buy a house, when to buy a car, when to get a credit card. all that revolves around having a good credit score. So with that being said, what can someone do to check their credit report?
I love this. Yeah, this is absolutely one of those things that is important to keep a handle on. And I personally had to go through this about a year ago. So I'm old enough not to have lived at home for, over, 25, 30 years or something, right? My mom contacted me about a year ago. She said, hey, Chris, I'm getting mail sent to me from a financial institution, and it keeps coming, you know what I mean? This mail stacking up. So I'm like, okay, open it, and I don't live necessarily that local to my parents, but what happened was at some point along the line, somebody got a hold of my information, and somebody was trying to open up some accounts and take out some loans in my name. Luckily, the last address on record they had was my parents' address, which I haven't lived at, like I said, in 30 years. So knowing, working in this business, I immediately did this, right? So I immediately said, I have to check my credit report. That's the absolute first thing I need to do. So there's lots of websites out there that offer credit reports. You'll see some commercials. So you want to do your due diligence and check that out. Oftentimes they require a credit card payment, some sort of payment, or you put a credit card on file to be able to see your credit report. I want you to write this down. It's www.annualcreditreport.com. So it's www.annualcreditreport.com. It's the only source of 100% free credit report. There's 3 credit reporting agencies out there. I know there's been some rule changes, so I don't want to say specifically how often we're able to view our credit report. But it's at least once a year. There's 3 credit reporting agencies. So when you go to that, you're going to be able to choose one of them, right? So that means, at least per the previous rules, I think it's a little more frequent right now. You can do it, but that means 3 times a year you could check what's on your credit report. I just tell you real quick why that's important. In my case, I wanted to know, was somebody successful? Was there an open line of credit out there that I didn't know about, right? And like General DeFore said, it's good to know prior to maybe applying for an auto loan or a mortgage, what's out there, right? Maybe I share a name with, people make mistakes, right? Maybe I share a name with my father, which I don't, but you know what I mean? Or somebody else. And there's a keystroke error somewhere. And now all of a sudden there's a mistake on there. This is a great opportunity to go out there, see what's on your credit report. Have I been hacked? Has my identity been stolen? Just to kind of know what's out there. Again, this is something I use with college students a lot as they're getting ready to graduate, to help to demystify their student loan information. Like, I don't know, like, how many student loans do I have? And I'm like, every semester it kind of resets. Do I have 8 student loans, 1 student loan? How do I figure this out? A great place to go and see how many lines of credit are open is to get your credit report. I would go to annualcreditreport.com.
Yeah, it's kind of interesting that you talk about your own personal experience. I remember when I bought my first house, when looked over my credit report, and there's another Timothy DeFore, different middle initial, that lives in Phoenix, Arizona, that just bought a motorcycle, and that showed up on my credit report. So ultimately, we got it straightened out, but it can happen to anybody. That's why it's so important that we go on websites that you had just mentioned, AmericanCreditReport.com, and check your credit report. And seeing that's April's Financial Literacy Month. Every year, I think April would be a good time to do that on a regular basis. So thank you for sharing that extremely helpful information.
Absolutely.
So such as yourself, there are a lot of parents out there who, when it comes to their children, the question I have: should they pay their child an allowance? And by paying them an allowance, is that going to help or hurt them in the long run?
Yeah, good question. I know in my case, we've we've gone in and out of the allowance, and that type of thing. So this is very much personal. It really depends on the dynamics
I'm
of.
helping raise a 15-year-old, so I'm right with you.
Okay, yeah, of each family. But I would say in general, the great thing about an allowance, it can provide that link again, a link between work and payment, right? You know what I mean? If I do certain tasks, do some work, I can, I can earn something, you know. It also gives parents a chance to teach money management concepts. I mean, you could parlay this with the jar, with the jar exercise. Um, so to teach the budgeting and saving and giving, really, so without that oversight of that sharing of knowledge, in the future, a child could make poor money management decisions, not understand why it's important to save and things of that nature. And you certainly wouldn't want them to carry that through their life. One of the cons I hear, again, this is a very personal topic, I feel, is, and I've also noticed this with my kids, is that, paying a child to do household chores could devalue significant lessons of just doing chores as a way to contribute to the greater good of the family. And doing that without financial incentive. I've been in that situation, like, hey, go clean your room. Like, what are you gonna give me? Well, I mean, nothing. So yeah, it is good. But you have to kind of look at your, each individual family and see how that would work. But I think that there's definitely some positives that come out of paying allowance, and you find those teaching moments in it for sure.
Right. And one of those teaching modes is knowing to take down the trash on Monday and cut the grass on the weekend.
Exactly.
So, but anyway, that's really helpful. So we talked about money smart tips for youth. Let's talk a little bit about money smart tips for young adults. A lot of kids graduate from college. Their goal may ultimately be to buy a house. So can you walk us through what those tips should be and explain how to get a mortgage, and, well, quite frankly, how does the mortgage work?
Yeah, great question. Let's start off by defining a mortgage. So first of all, a mortgage is a loan from a financial institution like a credit union. Mortgage is specifically designed to purchase a home, whether it's a freestanding freestanding single family home, a townhouse, or a condominium. And the property you buy serves as collateral for the loan. If the borrower fails to make payments, the lender can foreclose. They call it foreclose on the mortgage or on the loan, and retake possession of the property, since the property is the collateral on the loan. So a good first step is to establish a relationship with a trusted financial institution. We give college students, where we work on quite a few college campuses, the opportunity to start that relationship young. While they're in college, develop that relationship as they move through graduation and young adulthood. But because we know how valuable an asset such as a home can factor into their financial future, we've actually introduced a first-time homebuyer mortgage program just for those purchasing a house for the first time. I've been talking about this a lot lately. It's really exciting. There's really two highlights I'd like to point out on this mortgage is that we offer up to 100% financing on this mortgage, which is really significant. A lot of times, especially today, property values being what they are, interest rates being a little higher, just getting started. If someone wants to jump in and make that very important, financial decision, you're not necessarily sitting on a pile of money. So the opportunity to finance 100% of that 100% of that loan is sometimes a difference. between getting it or not. Another really great feature about that loan is it does not require private mortgage insurance. I know, thrown out some of these terms, like, well, what is that? It's oftentimes referred to as PMI. So I'll just give you some tips here as you're looking down a mortgage balance sheet. Any mortgage person is going to provide you a good faith estimate of like, here are your mortgage costs, right? Here's everything that goes into it. And if something is private mortgage insurance or PMI pops up, that's what this is. And oftentimes it's I don't want to get too much into this, but it can be charged if you're financing like 100% of a mortgage, like I'm talking about here. Our first-time home buyer mortgages do not charge PMI, which can be a significant savings as well. There's a couple other additional options for first-time home buyers that are available. Some of them may require PMI. So, that's just something, if anyone's interested in getting more details, should visit PSECU.com/mortgage, PSECU.com/mortgage, or call into PSECU. There's a 1-800 number. It's 1-800-237-7328. It's 237-7328, and actually talk to a mortgage specialist. Somebody that knows a lot more of the specifics than I do, but yeah, mortgage is such a big decision. It's a big learning curve there.
Exactly. And you know what? And the information that you just gave, not only is that helpful for young adults, it's helpful for any adults, for anybody any first-time home buyer. That's really good information for them to have. So for anybody who is thinking about taking the next step into home buying, it's just good information. So as we end our session today, I want to ask one more question, and that is, if I'm a student, if I'm a young adult, what is the first thing that I should do to set myself up for being successful financially?
Yeah. Make sure you're banking with a financial institution that has your best interests in mind. Ask questions, know what's available to you. Consume things like this, right? Consume things, know what your credit score is. We are, for our members, it's a free service they can sign up for. And again, one thing I always pitch to college students and their parents is, if you're starting to work on building your credit score, and you want to see what it is every month, we send it to you for free every month. And other institutions do as well. So check on that. I talk a lot about college students. And one of the things that you have to be careful with, there's financial institutions that'll offer us a student bank account, right, which could have no fees attached to it. But once that student graduates and they're out in they're out there in the workforce and working, and they also then graduate from that student account. They've got to know what's next, right? Are there all of a sudden fees on that account and things like that? So definitely know those things, and as boring as it is, read the fine print and ask questions. Developing that relationship with the financial institution early on can pay dividends as you progress and change through the years. And again, one of the nice things about PSECU is, those students don't have to worry about their account changing. We pretty much treat all members the same in that respect. We're not gonna, we don't take a student and graduate them to an account where we're gonna start charging them fees and things like that. It's the same account. So be a smart consumer. See who offers you don't have to just have one account. I have multiple accounts for multiple financial needs, for sure. Find one that offers free and low cost products and services, competitive rates, and really good member service. If you're in a jam, you want to know that you're taken care of. And another thing I have to say again, I've talking about back to the college topic, because of our partnership with the schools of the Pennsylvania State higher education system. That was a mouthful, make sure I had that right. And some private colleges and community college students that have graduated or even attended one of those colleges are eligible to join our credit union and take advantage of all those things we have to offer now and in their future.
And I can't, so, and thank you for all the information. It's all very, very good information. Can't thank you enough. Chris Ryan, Pennsylvania State Employees Credit Union, thank you for being with us today. Greatly appreciate it. Thank you.
Thank you. My pleasure.